All right, so today we're jumping into a topic that, let's be honest, can sound pretty intimidating: derivatives. But I want you to just forget all the scary headlines for a minute, because what we're going to do is break down how these incredibly powerful financial tools actually work, starting from the very basics.
So to get our heads around this, let's start with a really simple question. Just imagine for a second you're running a business. What's your biggest headache? It's uncertainty, right? You have no idea what the future price of your materials will be or what the interest rate on your loans is going to look like. So what if you could just kind of reach into the future and lock all of that in today? Well, that's the exact puzzle derivatives were invented to solve. At their core, they're just tools for managing and, yeah, even trading risk.
Okay, but before we look at any of the specific tools, we have to get our heads around the one rule that governs this entire universe. I mean, this principle is so fundamental that the entire system is basically built just to enforce it. And it's called the no free lunch rule.
So in the world of finance, this free lunch has a special name: arbitrage. It's basically when you can make a guaranteed, totally risk-free profit without putting up any of your own money, usually just by spotting a tiny price difference for the same thing in two different places. Now, here's the crucial part. In any market that's working properly, these opportunities just shouldn't exist. In fact, the entire structure of how derivatives are priced is designed to hunt down and stamp out arbitrage, making absolutely sure there is no such thing as a free lunch.
Okay, so how does this rule actually work in practice? Well, you have to realize that every derivative has two prices. There's the market price, the one you see blinking on a screen, and then there's its theoretical price. That's the fair price, what the math says it should be worth if there are no free lunches to be had. When those two prices drift apart, it's like a glitch in the financial matrix. And that glitch, it creates one of those arbitrage opportunities, which traders, instantly pounce on. And in doing so, they push the market price right back to where it's supposed to be. This constant, self-correcting process, that's the engine that really prices derivatives. All right, so with that core rule in our back pocket, let's look at our first building block. The simplest derivatives are really all about just one thing: agreeing on a price today for something that's going to happen way down the road.
This is what we call a forward contract. And right away, it introduces a really important distinction we have to understand. See, the price you agree on for that future sale, that's locked in. It's fixed. But the value of the agreement itself, oh, that can change a lot. As time goes on and the market moves around, your little contract to buy or sell at that old fixed price can become incredibly valuable or, a massive liability.
Okay, let's make this super concrete. Imagine you sign a forward contract. You agree to sell a stock that you own 9 months from now for exactly $250.56 a share. Boom. Just like that, you've completely eliminated your price uncertainty. It doesn't matter what the stock does between now and then, you know exactly what you're getting for it.
Okay, so now let's jump forward 3 months in time. It turns out the stock price has actually dropped on the open market. It's down to $245. And because of that, the fair price for a brand new forward contract has also fallen. But you don't care about that. You are still locked in to sell at your original, much higher price.
So, what's your contract actually worth now? What's the value of your position? Well, that original deal is now worth a positive $6.65 per share to you. Now, why is that? It's because you have this guaranteed right to sell for over $250 while everybody else is stuck dealing with a market price that's closer to $245. You locked in a fantastic deal, and that deal now has real tangible value.
Okay, so forwards are great. They let us lock in a price. But what if your risk isn't just a single price point in the future? What if it's an ongoing, totally unpredictable stream of payments? Well, this brings us to our next tool: swaps. And you can think of these as basically a way for two different parties to just trade their financial problems for solutions. And trust me, you've probably felt the effect of these in your own life without even realizing.
So let's meet Company A. They've got a loan, but here's the problem. The interest rate is variable. It floats with the market. For their accountants, this is a total nightmare. 1 month the payment's low, the next it could shoot through the roof. What they really want, more than anything, is predictability.
Okay, now let's meet Bank B. For a big bank, dealing with fluctuating interest rates is just another Tuesday. It's what they do all day, every day. They have the scale and the tools to manage that kind of risk easily. So when they look at Company A's problem, they don't see a risk, they see an opportunity. And the solution they offer is called an interest rate swap.
So here's how this clever little arrangement works. Company A agrees to pay the bank a nice, steady, fixed interest payment, the same amount every single month, predictable.
And in exchange, the bank agrees to take over and make Company A's unpredictable, variable rate loan payments for them. So what happens? The company gets that certainty they were desperately looking for. They can actually budget now. And here's the thing, it's a perfect trade. Company A got rid of a risk they weren't equipped to handle and got a predictable cost in return. And Bank B took on a risk that, for them, is no big deal to manage. This exact logic, by the way, is what makes things like fixed-rate mortgages possible. I mean, think about it. Each party just swapped a risk they didn't want for a payment stream they preferred. It's a total win-win.
Okay, so we've covered locking in a future price with forwards, and we've covered swapping payment streams with, well, swaps. But our final building block introduces something that's maybe even more powerful, and that is the power of choice, the power of maybe.
Just take a look at this comparison. It's absolutely key. With a forward or a futures contract, you are obligated to go through with the deal. You have to buy or sell. It's a commitment. But with an option, you're buying something totally different. You're buying the right, but, and this is the important part, not the obligation to make that deal. It is not a commitment, it's a choice. And that flexibility, the power to just walk away if the deal turns out to be bad for you, that's what makes options so unbelievably versatile.
So, of course, this leads to a really fascinating question. If an option is just, well, a choice, how in the world do you put a price on that? I mean, think about it. Pricing the right to do something, without the obligation to do it, that was a puzzle that stumped the smartest people in finance for decades. That is, until the famous Black-Scholes-Merton model finally cracked the code.
And look, while the math behind that model is, let's just say it's pretty intense, the logic is actually super intuitive. The value of that choice, that option, really just depends on a few key things. First, how much time do you have left to make up your mind? The more time, the better. Second, how jittery is the market? We call this volatility. A more jittery market gives your choice more chances to become profitable. And of course, how close is the current price to your target price? You put all those factors together and they determine the fair price for maybe.
All right, so we've looked at forwards, swaps, and options. On the surface, they all seem pretty different, right? But to wrap things up here, I want to show you that they are all, and I mean all of them, built on the exact same two foundational ideas.
And honestly, this is the key takeaway from our whole discussion today. You don't have to be a math whiz to get this stuff. You just need to understand the simple, powerful economic logic that ties it all together.
Okay, principle number 1 is our old friend, the no free lunch rule, or no arbitrage. What it says is that the fair price of any derivative has to be exactly equal to the cost of creating a do-it-yourself portfolio, using the underlying assets and some borrowing or lending that gives you the exact same future payout. If the prices aren't equal, well, that's a free lunch, and the market will slam that price right back into line.
And the second big principle is that, at the end of the day, this is all about future cash flows. The value today of any of these complicated-sounding instruments is really just the sum of all the cash we expect it to pay out in the future, adjusted back to today's dollars to account for time and risk. That's it. Honestly, every one of those complicated formulas is just a fancy way of expressing that one simple idea.
So, what have we seen? We've seen that derivatives aren't some kind of financial black magic. They're just tools built on some really simple, elegant logic. They're tools for managing risk, for valuing future promises, and for putting a price on choice. So I'll leave you with this question. Now that you get the basic logic of how we price and trade the future, what part of our economy looks different to you now? I mean, from your mortgage rate all the way to the price of a gallon of gas, how does it change how you see the world?